Joining us now to talk more about the changes made to the Dow Jones Industrial Average is David Blitzer. He's chairman of the S&P 500 Index Committee. David, great to have you with us. You have been presiding over these kinds of changes for a long, long time. So put it in perspective for us. What does this mean for investors if they own the stocks of Visa, Goldman Sachs, or Nike, or if they're thinking of buying it? What does all this mean?
Well, the stocks, the fact that they reacted today is no surprise. This kind of news puts stocks in the news and people respond to it. But the reactions are typically very short term. My guess is by the end of this week, or if not by this time next week, those reactions will all be out and there won't be any permanent changes. And I think the ones that were mentioned earlier, the permanent changes were the general movements of the market, much more than the stocks. What it really means for investors is that the Dow is a slightly different index, and I believe, and we all believe here at S&P Dow Jones, a much better index. It's price-weighted. The three stocks that came out together were only 3% of the index in terms of their weight. The top stock, IBM, was 9.5%. IBM is going to squeeze down to 8%. It won't be so dominant. The smallest stock, instead of being 0.4%, will be about 1%. So we have a much better balance in the index than we did before. It will be a more reliable indicator of what's happening in the market.
You have replaced, David, three lower price stocks, in fact, the three lowest price stocks with the Dow, with three higher price stocks. In this price-weighted index, which is a really critical concept to appreciate here, does this change make the Dow more volatile, less volatile, no change at all?
If anything, I think it might make it a touch less volatile. When one point in the stock, whether it's on an $8 stock like Alcoa or a $185 stock on IBM, 1 point does the same amount and that kind of thing. But when you have an $8 stock, it just tends to bounce around a lot more than the $185 stock. So if anything, maybe a touch less volatile. But the volatility wasn't really a concern. These are all big, well-known, liquid stocks. This is not like emerging market stock where they bounce like crazy or something. So we weren't worried about that.
You know, David, when investors hear about changes like this, they start thinking like, well, why didn't this company or that company get invited to the index? And the two names that came up a lot today, Google and Apple, they have a huge influence on the economy, and they are widely traded stocks. What's the story there?
All right. Well, first we should say about Google, Apple, and all the other stocks mentioned, changing an index is not an investment recommendation by any means, neither positive nor negative. Google is about $885 a share. Apple, I don't know the number offhand, but it's well north of $200 or $300. Had we put Google in the index and taken out a stock with a price of $100, Google's weight would be about 28%. And if we put Apple into it, it would be the Google Apple Index and nothing else. And that's not what we're doing. We want 30 stocks that do a nice balanced job of representing the large cap blue chip part of the market. And I think that's what we're getting this time.
By the way, David, Apple stock is around $500, and we're going to be talking about that a little bit later in the program. But thanks a lot, David. David Blitzer, chairman of the S&P 500 Index Committee.